Hi, everyone. Welcome to my presentation, The Tariff-Driven Equity Market Sell-Off. I'm Gene Goldman. I'm Chief Investment Officer for Cetera Financial. What we'll do today is do three things. Number one, I'll talk about our three themes coming into 2025. And I think these themes kind of help to level set how we got here in terms of all this market volatility and all this uncertainty. Second of all, I'll talk about the tariffs and the ensuing market reaction. And then lastly, probably the most important point is that why I believe that by year end, stocks will finish the year higher than they are right now. So more of an optimistic tone. So let me dive right in. So coming into 2025, we laid out three themes for all of you. And these three themes are number one, the great moderation. Everything is slowing down. The economy, the labor market, stock market returns, bond market returns. We call this the great moderation. Our second theme is simply this. The Fed proves to not be a good friend. So remember last year when we chatted and we said that our big theme was the Fed goes from being a foe to a friend. They go from raising to cutting interest rates. Well, this year we take that theme a little step further, and now the Fed cuts rates, but they're likely to cut rates less than they said they would last year. So they proved to be not a good friend. And our third theme is simply this. Diversification is back. You know, the strategy of allocating assets to different parts of the market. Well, in the last couple of years, the more you allocate away from, say, artificial intelligence, technology, large growth, for example, really other parts of the market didn't do well. We do believe that diversification, again, that strategy of allocating to parts of the market should do well in this environment, especially as we are pretty volatile in terms of stocks and bond market returns. So if you look at these three themes, there's a slight air of caution. And with that said, we weren't surprised that we would have a market correction. And a correction is when stocks fall from top to bottom by 10% or more. We were more surprised it took so long for the markets to actually have a correction. You know, if you think about corrections, they occur on average about once every 12 to 13 months. We hadn't had one for over a year. Second of all, there was a lot of uncertainty in the economy and the markets at the beginning of the year. Part of it was the fact that January was the coldest January since 1988. We also had a very long extended flu season. So we saw a lot of pressure on weather sensitive sectors like construction, like leisure. So there was all these thoughts about a potential recession. Then we had a Chinese company called DeepSeek announce a cheaper version of a large language model. We'll get into AI and large language models in another time, but basically we are in the midst of a data revolution. And to read all this data that's being created, you need a large language model to understand that data. Well, this Chinese company called DeepSeek comes out with a cheaper version of what all other companies have been looking to implement. So now this puts into question, well, maybe the companies that spent all this money on AI won't get as much benefits as they thought they would. So this put the technology sector in sort of this whole tizzy, this uncertainty. So you take those perspectives, plus we had high valuations, we had a lot of extreme market optimism, which is a contrarian indicator. You take all this together, to us, we expected a market correction, nothing more than that. So again, our key point of what I'm trying to say here is that these are our three themes, a little cautious coming into the beginning of the year. So a correction that we had was not a big surprise. But with that said, there was an announcement in an attempt um, to get trading partners to reduce sort of these trade imbalances. President Trump on April 2nd announced, as part of this so-called Liberation Day, announced some tariffs that at the end of the day were a little bit more aggressive than even the most extreme trade scenarios. If you look at this chart, for example, and you see a bunch of horizontal lines, the horizontal line on the top is if all the tariffs that were announced were implemented, that equates to an effective tariff rate of about 25.3%. And the second line is sort of if you use substitution effects, like instead of buying sneakers from one country, you buy another pair of sneakers. So long story short, look at the top line, 25.3%. And let's put this in perspective. That tariff rate, 25.3%, is the highest since 1906. It's even higher than the so-called Smoot-Hawley 1930 Tariff Act. And if you go back to 1930, what happened was that The US government increased tariffs on foreign countries in 1930 to protect farmers and domestic businesses. Then other countries retaliated back and raised tariffs on us. And historians generally believe that that was one of the primary causes of the Great Depression. So, not a great scenario. If you think about from a scenario standpoint, how tariffs affect our economy, what happens is that tariffs are added to the price of goods imported into the United States, and then companies pass these costs on to consumers like you and I. Because prices go higher, because there's more inflation, then this creates what's called a demand, like a destruction of demand, and we stop buying other goods. So, long story short, tariffs are not really great for our economy because it increases prices and it reduces economic growth. And that scenario is a classic, what's called a stagflation environment. Stagflation is when the economic growth slows down, but at the same time, inflation rises dramatically. And then the worst case scenario would be a recession where economic growth just falls dramatically. So we're already starting to see some of the effects of tariffs on economic data. If you look at hard data, and hard data is that tangible data that gets released, like gross domestic product, consumer prices, the payroll report, actual data. We haven't really seen the effect of tariffs yet, but if you look at soft data, and soft data is like survey data, surveys of consumers, surveys of businesses, you're starting to see some effects of tariffs affecting those data points. Let me show you an example. As we go to this next slide, one very important soft data is what's called the ISM survey. ISM stands for the Institute of Supply Management, and they do a monthly survey of both manufacturing businesses and services businesses. And they interview basically purchasing managers. And purchasing managers are those people on the front lines of business. And they're asked a bunch of qualitative questions about business and prices and supplies. Whenever the index is above 50, it's expansionary. Below 50 is contractionary. So if you look at this is a component of that overall survey. This is the prices paid survey. You see here, prices are surging. And again, this does not even reflect the liberation day, the tariffs. This is companies buying goods in advance of the tariffs, putting upward pressure on prices. So prices are rising even in anticipation of tariffs. So again, very inflationary. Now, if you look at this chart, this is the other side of the equation. Higher prices, as I mentioned before, creates demand destruction because basically, if prices are more expensive, you don't have as much money to buy other things. So you look at this chart, this is another component of that ISM. It's called the new orders component. And basically, you see new orders are falling fast, and new orders are a very forward-looking indicator. So you have higher prices, reduced new orders, also supply chain issues. You take all this together, it's a big overhang on the economy. And here's a good rule of thumb. Generally speaking, a tariff-related hit on economic growth is about 10% of tariffs. So as I mentioned before, the effective tariff rate, if every tariff that was announced was implemented, it's about 25.3%. So how does that translate to that 10% in terms of the impact on economic growth and inflation? Well, basically that suggests that based on that tariff rate, inflation would rise by about 1 to 2%, and economic growth would fall by about 1 to 2%. And just as a good data point, we saw the International Monetary Fund meet recently, and they came out and said because of these tariffs, U.S. economic growth should be reduced by about 0.9%, so close to that 1%. So long story short, as we go through all this, tariffs in general increase prices and they can reduce economic growth. That's what the markets are worried about. And to show you what the markets are worried about, if you look at this slide, you can see the market reaction has not been that great. Here's the S&P 500, and you see the S&P 500 has gone higher and then come down. That coming down was basically concerns about tariffs and the effect on the economy. So if you look at this chart carefully, there's a bunch of horizontal lines. There's a 10% correction, and we've gone through there. So 10% is when stocks have fallen from their peak by 10%. Then there's a 15% correction. And then the thing to watch carefully is what's called a bear market. And a bear market is when stocks fall from top to bottom by 20% or more. As a side note, the importance between a correction and a bear market is really, really important. Generally speaking, a correction occurs when the stock market is thinking, hey, maybe a recession could be coming. A bear market is when the stock market says a recession is probably coming or we are in the middle of a recession. A great example would be the 2020 COVID recession. Remember back in February and March, stocks sold off by about 35%. That was the market saying we are headed to a recession. It is coming in fast and furious. So if you look at this chart, we did not hit a bear market. We went through a bear market level, but we didn't close below that level. So basically we were at one point teetering on a correction or a bear market. And this is basically the stock market saying, we're not sure yet if we're headed towards a bear market because of a recession or not. Keep in mind, a recession is such an important point because historically, we've only had three bear markets without a recession. 1962, 1987, and 2022. So usually if a recession happens, that helps to drive a bear market. So the good news here is that the markets are saying maybe not a recession yet, but let's watch it carefully. So overall, that's the bad news, that we've had a lot of pressure on the economy, a lot of pressure on prices. The stock market reaction has been not that great. So you take all this into consideration, it's been not a great opportunity in terms of the stock market and the bond market. But with that said, though, here's my key point I want to talk about. I want to talk about why I do believe that stocks will be higher by year end than they are right now. And yes, I do admit there's going to be a lot of volatility in the stock market because, as we all know, tariffs tend to go up faster before they come down. So they're very sticky. Also, just the sheer number of countries that need to be negotiated with can take a long time. And there's also a lot of non-tariff trade barriers like European value-added taxes, which are going to take a lot to get through and figure them out. So there's going to be lots of market volatility. But with that said, what are some things we can look at to be optimistic about? First and foremost, you look at this slide. This slide shows what's called the AAII stock market sentiment. Long story short, this is basically saying what percent of people out there are bullish or bearish. In this case, what percent are bearish. And you see the little red circle? At this level that we are at right now, historically, whenever we get to this level, stocks have bounced back, have turned around. This is a contrarian indicator. So usually at these levels, you see stocks reverse course. Because again, if everyone's bearish, everyone hates stocks, it tends to be a contrarian indicator. Keep in mind, at the beginning of the year, remember, it was the exact opposite. Everyone was bullish. Everyone wanted to buy stocks. And that's also a contrarian indicator that stocks tend to go down. So again, long story short, the first reason is that everyone is bearish. That's good news, suggesting that we could see a bounce back. Another reason is I think that the Trump administration is understanding that the economy is facing pressures from tariffs, a lot more than anticipated. If you look at this slide, this is another soft data point called the University of Michigan Consumer Sentiment Survey. Basically, it's a survey of you and I as consumers. How do we feel about economic growth? And you see this little line on the right-hand side, it's fallen down dramatically. Consumers, you and I are getting really worried about the impact of tariffs on the economy. Again, consumer sentiment is falling. Remember, tariffs are also very inflationary. And you look at this chart, another component of the consumer confidence is 1 year expectations. Where do you see inflation 1 year from now? And I couldn't get this chart updated because we were having a data issue, but you see that red arrow? That's where it is right now, up to 6.7%. Basically, this is the highest level since 1981. So high inflation pressures are likely to pressure you and I as a consumer. So there's definitely an economic impact. Then there's also a stock market and a bond market impact. We talked about the stock market impact before. Stocks fell dramatically, but the bond market impact is much more worrisome. So let's take a step back and talk about something. So when we all went to school, we all learned about investing. And when I went to a class called Investing 101, I learned the simple fact that basically when you go in and invest in financial markets, it's very much of a binary decision. You either buy stocks or you buy bonds. Yes, you can buy other things, gold and whatever else you want to buy, but let's just keep it simple. You buy stocks or you buy bonds. When stocks start to fall, that means people are selling out of stocks and they can go in and they're going in and they're buying bonds. I know there's assumptions there, but just stick with me. So when stocks go down, people are selling stocks and buying bonds. When you're buying bonds, you're putting upward pressure on prices and yields start to fall. So long story short, when stocks fall, yields start to fall. What we saw in the week after Liberation Day, stocks fell. Again, it makes sense because of tariffs and because of inflation and concerns about growth. But bond yields went up dramatically. That's what worried the Trump administration because all of a sudden something was wrong. You look at this chart, we saw an 11.5% spike in the 10-year Treasury yield. The 10-year Treasury yield in a week went from about 4% all the way up to 4.57 in a week. That's a big spike on a fairly conservative investment. So, what this was saying to the Trump administration was something was breaking in the bond market, and this really freaked out the administration. And I know some naysayers were saying, well, maybe the treasury market was repricing in inflation. Now that we have more inflation, yields have to move higher. Maybe, but keep in mind the spread between inflation protected bonds and treasuries is about 2%. And that's a pretty good target. That's what the Fed's target is. So it wasn't an inflation surge. And also that week that we saw this big spike in treasury yields, we saw a very good 10-year treasury and a very good 30-year treasury auction. If there was worries about inflation and yields moving higher, demand for treasuries would have been a lot weaker. So we saw a huge demand for that. So take all this together, basically weaker economic growth, concerns about higher prices, and the sharp sell-off in treasuries pushing yields significantly higher. This said to the administration that maybe we got to take a step back and start to reevaluate our thoughts on tariffs and the impact on the economy and the financial markets. So clearly, it shows that President Trump and the administration was much more focused on the impact on the economy and the markets. So therefore, we're optimistic that they'll continue to realize that this could impact the economy. So another reason to be optimistic is that there's a market and economic impact on these tariffs. As I mentioned before, stocks sold off, so we have valuations that are much more attractive. Here's the price earnings ratio of the S&P 500. See the little red circle? We are now below the 10-year average. Stocks are more attractive than they were. Remember, a couple months ago, they were at around 22 times forward earnings. Now they're down to about 18 below the 10-year average. Great news there. And then there's another reason to be optimistic is that there's a greater chance of a so-called Fed put. So the Fed put basically means is that if the markets start to sell off, if the economy weakens, the Fed will come in and lower interest rates. Classic example was going back to 2020 again. COVID starts to hit our economy. Things start to slow down. The Fed came in and surprised and cut rates by 0.5%. That's what's called a Fed put. And yes, there's some concerns that inflation is still high and the Fed may not cut rates in a higher inflation environment. So we do think the Fed will stay on hold for as long as possible. But here's a Fed put. If the economy weakens dramatically, the Fed will come in our opinion, and cut rates in order to help stimulate the economy. And if you look at this chart carefully, that green ziggy-zaggy line where I have the red arrow above it, that shows what the market is saying where the Fed interest rate, the Fed funds rate will be at year end. So today you see the horizontal line, it's at that 4 3/8 level. The Fed said in their own statements that it'll probably be about 0.5% lower by the end of this year, but the market is saying, Fed, we don't believe you. We think it's going to be even lower. The market is pricing in a greater chance of a so-called Fed put. Another thing to think about too is that the economy will weaken. Let's face it, we'll see a slowing in the economy because of tariffs and their impact on economic growth. But the good news is that we are coming off of an even stronger base in our economy than was thought previously. Here's an example: the labor market. You look here where I have the red circle. The labor market, that's monthly payrolls. And that monthly payroll number, the last month, came in well above expectations. You have that, you have pretty low jobless claims, you have an unemployment rate pretty low at about 4.2%. You have stronger than expected retail sales. All of these suggest that the economy still has some firepower. Yes, all those data points should weaken in a tariff environment, but they're coming off of a much stronger base than was anticipated previously. And then another thing to think about to be optimistic is that tariffs could create a large source of tax revenue. If you think about tariffs, tariffs are creating tax revenue potentially between 500 billion to 750 billion. And if those tax revenues could be reallocated or recycled back into the economy, we could avoid some type of recession. And some early indications in terms of a lot of the Senate Republican budget plans that we're seeing kind of being reviewed and worked on, a lot of them are very pro-growth in details, including the extension of the Trump 2017 tax cuts. So the good news here is that if these tax revenues are circulated back into the economy could help us avoid any type of recession. And I think lastly to think about is that the US has the advantage in the trade war. It's my opinion. If you think about China, China has advantages. They are a major exporter of rare earth materials, minerals. They control supply chains for consumer goods. They also can route trades through other countries to avoid, paying tariffs. So they do have some advantages. But the US has some major significant advantages. You see here, for example, the US has a much stronger consumer base. So the horizontal line on the top is the percent of consumer spending as a percent of GDP. So right now in the US, we're about 70%. China, on the other hand, is around 55 or 56%, as you see here. Part of the reason is that China had a one-child policy back from 1979 to 2015. So because of that, they have their birth rate slowed down dramatically. And in theory, those births that did not happen would be major consumer spenders right now in the Chinese economy, and they aren't there. That's why Chinese consumer spending has been lower than the US. So the US has the consumer base that China needs to sell their goods to. So I do think we have the trade advantage. So I do think there'll be some type of negotiation that gets resolved between the US and China. Again, a positive reason. So as I wind down, listen, tariffs are going to overhang the economy for some time until they get resolved. There's going to be a lot of market volatility. The question is, what do you do? And as I always say, there's two things you do. Number one, you be diversified. And being diversified makes sense. Diversification, that exposure to different parts of the market. Don't just bet on one single slice of the market. Be diversified. And diversification is working. If you look at these charts show the performance of US versus non-US. The line moves higher, US is outperforming. When the line goes down, like it's in the red circle, this year, US is underperforming. Non-US assets are doing really well. That's the power of diversification. Another way to look at this is growth versus value. Growth stocks like AI and technology have done extremely well, but the other side of the market, value is doing well now. You see this chart. If the line goes higher, that's growth outperforming. If the line goes lower, value is outperforming. And see the red circle? Value is really doing well. This is a sign that diversification has worked. So the first thing, be diversified. Have exposure to different parts of the market. And the second thing, as I always tell you, is don't be too aggressive or don't be too conservative in your portfolios relative to your long-term objective. And how do you make sure you are? Reach out to your advisor, sit down with he or she and go over your portfolio, go over any changes to your lifestyle, any changes that they need to be aware of. Make sure that they are fully aware of these because these are so important to make sure your portfolio is aligned with your long-term objective. Thank you so much. If you want to follow my team or I on Twitter, here are handles or X as it's called now. I really want to thank you, and I need to share these disclosures with you. And thank you so much. Thank you so much, and have a great day.